Okay everyone, welcome back. So in this video, I'm going to be going over how to plan your week ahead, right? So I'm going to be looking at three of the most requested markets. So S&P 500 futures, gold and Bitcoin. So if you trade any futures market, gold, Bitcoin, and this applies to Forex as well, stick around. So I'm going to be showing you what levels I'm trading from and exactly how you find these key levels. So we're going to kick off with ES and we're going to go over a few basic things, right? So on ES futures, these are my levels, and stick around for this entire video because I'm going to break down exactly why these are levels, why you want to be focusing on these specific prices, and how you can trade at these prices, right? So in trading, you need to know which levels you're trading from, otherwise you are basically gambling. And so to avoid gambling, it's better to know where the buyers and sellers are sitting, where the most volume was transacted, and most importantly, whether price is breaking supply or breaking demand, right? So there's specific levels you want to be paying attention to going into the week ahead. This is for ES. So again, quickly, what makes a key level? There's three things I look for that make a key level, or mainly two things. The first is it must leave a 15-minute fair value gap. That is the first thing. The second thing is there must be limit orders absorbing market orders, right? This comes through the order flow. So we're going to speak about that as well. And also they need to be active levels, meaning prices reacted off them in the last 1, 2, maybe 3 weeks. And so a level can either be an area of supply or an area of demand. And the way you know that is by looking at limit orders and market orders through the order flow, right? So let's have a dive in. So on ES, we closed at 68.93 on Friday, right? PM session. And so the two levels that we're trading in between, the two levels I want all traders to focus on is key level 1 and 2. So that's around 69.05 and 68.75. Now there's another two levels as well, but the main two levels we are focused on are the ones that we open up in between, right? So when we open up on Sunday, right, afternoon EST, we want to be focusing on these two levels. So around 6900 and 6880, 6890, around roughly that sort of region. So I want to kick things off, right? Let's first focus on 6905. Now, why is 6905 a key level? The reason 6905 is a key level is because price left a massive supply, right? Or price left a supply in general. So last week on Monday, you can see here, this was Monday's price action, right? Then we went to Tuesday, we had Wednesday, Thursday, then Friday, we finished near Monday. So on Monday began the sell-off, right? So this circled region over here represents the sell-off. So that yellow box over there is our key level. Now, again, what made that key level valid was it came from a 15-minute fair value gap, and there were limit orders absorbing market orders, creating supply. So the reason that happened very simply is because of this. At 69.05, so this was around 69.01 to 69.10, roughly that sort of region over here, Monday sold off. And so what was going on in that yellow box? Well, this is the yellow box zoomed in on the order flow footprint charts, right? So this is the aheas platform. So what you can see here, right, this blue box is the same as this gray box. So if you're trading key levels and you don't truly understand who is in control at that level, then you have no business trading at that level, right? That level is just any random zone or any random line. What makes a key level valid is you need to know whether it's supply or demand. And how do you know whether it's, in this case, supply? It's by reading the order flow. So if you look at the order flow carefully, we're just looking at the three candles that tap in, 1, 2, and this big red candle. So let's take a look at this candle over here, right? We see 3 for 69. Now, I've made a lot of videos on how to interpret footprint charts and how to use the aheas platform to your advantage. But what's really going on over there is you see 3 market participants hitting the bid, and you see 69 market participants hitting the ask. So what that means is there's 3 aggressive sellers versus 69 aggressive buyers. All right, so for those who can do quick math, the delta is going to be 69 minus 63. So that's going to be 66. So we have a positive delta of 66. Okay, now we see the same thing over here. So we see 33 for 109. And then we see 13 for 69, right? So bearing in mind, this was the second sell-off, around about 11:30 Eastern. This was the first sell-off at 9:30 Eastern, right? So we're looking at the second sell-off in this scenario. Now over here, what we can see the same thing, right? We see 13 for 69 and we see 33 for 109. The ask is a lot greater than the bid. So if we go back to our definition of what actually makes a key level, once you have a 15-minute fair value gap, or you can apply this to trend lines and other kind of other kind of tools in that way. Once you have a 15-minute zone or a half an hour zone, I like to use 15-minute fair value gaps. You want to ask yourself the basic question: who is aggressive and who is being absorbed? Right? So what we can see is we can see market orders, right? More market buy orders hitting the ask than market sell orders. We see more aggressive buyers, but the market broke lower, right? Significantly lower in this case. This is an area of supply. The reason it's an area of supply and the reason it's a key level is because we can prove that there are limit orders resting at this level. 6900 to 6910 or around sort of 6905 area, there is massive supply. So if we go back to this slide over here, I have two key levels. The first one is 6905. Now the reason I'm looking at this as a key level is very simple. If we break above 6905, 6910, then we're going to use this area for a potential break and retest. So I am more inclined to be bullish. My bias going into Monday and Tuesday will be more inclined to be bullish if we can break above 6905, definitely above 6910. However, if we get to 6905 or 6900 and we see buyers stepping in, but the market breaks lower, similar to what happened here last week on Monday, that indicates that the sellers are actually in control. So when we open up next week, are we going to see this zone hold as supply or hold as demand, right? Whatever happens, this is a key level in the market that we are interested in. Now we're going to take that theory and flip it on its head. So we want to focus on 68.75. So that's the second key level, right? So we're opening at 68.93. We want to see how the market behaves at 68.75, right? So at 68.75, we had a couple of reactions this week. So this was specifically Friday's horrific price action. I took, I think, a break even and a small loss in this price action. But regardless of how you trade at your key level, you need to understand what's going on at that key level for future reference. So notice what I'm doing with key levels. Once we see good reactions, right? Once we see valid reactions here, 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 this is now key level 2, a 69.70, 69, sort of 80, 90 region. Once the market has shown you the aggressive sellers or the market order stepping in, don't ignore that zone. Keep dragging it over to the right, right? Because you want to be trading at the areas where there's the most amount of volume and the most amount of absorption, right? So that goes back to our definition of what a key level is. A key level is a 15-minute fair value gap, and we see limit orders absorbing market orders with the order flow. And so that's what's going on over here. So last week on Friday, we had this big kind of red candle, so this big kind of wick, and what was going on inside the wick was the opposite to here. So now we can see a lot of red delta. So I'm just going to go over a few specific rows. 440 for 223. That's roughly a 2x difference, right? Between the aggressive sellers on the left and the aggressive buyers. So the way you want to look at this is you want to be focusing specifically on who is aggressive and who is being rewarded, right? Those are the two questions you want to ask yourself. And that is what market orders and limit orders are about. Now, the basic question is this. You want to think through it like this. If you see a lot of red delta here, but the market breaks higher, and again, just over here, we see a lot of red delta and we see this big push to the upside, you want to ask yourself at this region over here, so this is our second key level, between sort of 68.70 and 68.90, 68 sort of 85 area, who is in control, right? Is it the buyers or the sellers? If we see aggressive sellers, so market orders hitting the bid, more market sellers than market buyers, but the market breaks higher, that shows you you're at an area of demand, right? So why is this important? Now, if we get to 2 and we see, a similar pattern to here, if we can hold above 2, right, key level 2, that means that the demand is still holding from Friday. We want to be bullish. We want to be buying in the New York session. However, if we break below key level 2, then we know that the previous passive sellers over here, they're passive sellers sitting over here, these previous passive sellers are not being rewarded. Therefore, you want to be going short around about 68.75 area, right? So that is how you want to be kind of, these are the levels you want to be paying attention to. So if we take this now to the trading view chart, right? So here we have the same sort of thing. So on Friday, right, this was the long I tried to take on Friday in the AM session, but the price action, we've had a lot of chop recently. There you go. So I didn't take this trade. This trade was, unfortunately, this one just was, if you try to take it, would have very horrible. We've been in a lot of chop recently, especially on ES futures. This was a trade that would have worked out. Now, this video, I'm not making it to go about specific trades. You want to be planning your levels, right? So again, what made this level valid if we break this down? One thing I often like to use, I like to use previous day lows, right? Previous day lows. So what we can see here is we see a gap or a 15-minute zone over here, 15-minute FVG, previous day low. So what I'm doing is I'm taking the candle before the zone and I'm just dragging it to the right? So I'm seeing how the market behaves at these key levels. Now, what makes a key level for me, I want to make this clear. It's not just any random fair value gap, right? I want to see how the fair value gap reacts with the order flow, right? Even this zone from Monday over here, so 6900 to 6910. This zone was actually derived all the way from, I've had this zone on the charts for the whole of November and the whole of December. The reason why, I've made previous videos on this, there were a lot of good trades resting in this region. Now, what makes a good trade, right? A good trade basically means there's limit orders resting at that region. So if I go now here to the market open on Monday, the 22nd, even though it's near Christmas, that doesn't really matter. Price doesn't know it's Christmas, right? This was Monday's short, right here. This was the Monday short that I took, right? I took this short on Monday. Now, just quickly breaking that down, what made that short valid and why am I still treating it as a key level? So on Monday, the short I took was this one over here, right? So there was a really good short from around 6,900 to about 6,880, right? This was the short itself. Now, the reason this is important to me is because there are limit orders, right? There are limit orders resting over here. So that is the definition of a key level. Once you find the correct fair value gap to trade from, you want to establish whether there are limit orders resting in this region. Now, limit orders, if you're a bit confused on that, what a limit order is basically this, right? What a limit order is this. So we're seeing over here large amounts of aggressive buying, right? We see large aggressive buying. These are market orders hitting the ask. Now, these aggressive buyers were unsuccessful to break above the level. Therefore, they've been absorbed by limit orders. Sell limit orders or passive sellers are resting in this region. So this is 6,900 to about 6,910 in that sort of region. That's where we're seeing the absorption. So if we go back to live markets for the week, this is what we want to see. So this is how simple your game plan should be, right? This is how simple it wants to be. We have key level 1, we have key level 2. There's also a key level down here at 68.50 to 68.40. So going into the week ahead, right, as we approach Christmas, if we get to key level 1 and we break above, you would then want to see this. You look for a retest. Again, you want to see aggressive sellers failing and you want to go long. If you get to key level 1 and you see the aggressive buyers stepping in, but the market breaks lower, you want to be shorting from key level 1 down to key level 2. And the same logic applies at key level 2, right? So let's say we come to key level 2 on Monday or Tuesday. If we can break above, we see aggressive sellers failing, then we want to be going long. If we break below, then we want to be going short. And you guessed it, we want to be targeting key level 3. So again, for ES futures, if you are trading ES futures, I want you to pay attention to the following two zones, right? So the two zones that we want to be focusing on are these ones, right? So for those who want to take a note, maybe take a note. So key level 1, 6,900, key level 2, 68.78 to 68. And then key level 3 around 68.50. Those are the 2/3 levels I'm looking for on ES. Okay, now moving on to gold, right? So I don't trade gold, but I get lots of questions about how do you form your key levels on gold. So gold, ES futures, even Bitcoin, they all follow the same narrative, right? Every market follows the same narrative. So on gold, I typically would start off on a 4-hour. And so the way that I mark out the 4-hour is like this. I'm looking for my structural highs and lows, right? So we can see high, low, high, and then we have a breakdown here, low, and we're currently dealing between this swing high and this swing low. And now what's happening is we had some key levels over here, some really big fair value gaps that we see price breaking through. So gold is typically, a bullish moving market. Let's break this down. So the 4 pillars I use on the 4-hour time frame for gold would be market structure, right? Those are the highs and lows you see circled. The dealing range, which is the most recent high to the most recent low. And so what that means is we have the most recent high and we have the most recent low. And so anything between all these internal highs and lows you see, they are internal highs, right? They're internal lows. All the structure you see here is irrelevant compared to the swing high and the most recent swing low. So that's the dealing range. Premium and discount, fairly self-explanatory. We have the 50%. Anything above is a premium. Anything below is a discount. And then fair value gaps are used with the premium and discount. So all the fair value gaps here that have held were from discount. Now we're heading into premium. Now what's interesting is the premium fair value gaps are starting to fail. So that just gives me an overall bullish bias. But this is the 4-hour. I don't like to rely and trade just on 4-hour zones. I think the 4-hour zones are too wide. Sometimes it can take too long to hit them. And 15-minute zones are a lot more accurate. So moving on now, this is how I have the 15-minute time frame of gold, right? So just to quickly mark that up on the charts, if we go now to gold, NQ gold. So this is how my gold chart is looking at the moment, right? So what we have over here, following the 4 pillars, what we see is again our high, our low, our high. Now I've got 2 levels I want traders to focus on. The first is this key level here. The reason why is because we left a huge gap, right? A huge inefficiency over here, a huge fair value gap. But when we look at how the price action behaved in this region, we want to be looking at the limit order. There were limit orders resting over here. So this is gold between 43.40 to 43.50, roughly this sort of region. Lots of limit orders. And we saw here price on Friday stalling, right? So this is a key level. So what makes this a key level? Going back to our definition, right? Let's go back to our initial definition. So we had our definition all the way up here. What makes a key level valid, right? What makes a key level valid? 15-minute fair value gap. You want to see limit orders absorbing market orders, right? So let's translate that to gold specifically. So I have 2 levels for gold. First one is the main one is 43.40 to 43.50, 55 area. So the aheas platform is what gives us the clue, right? So this zone over here is the same as this zone over here. So the aheas platform or the order flow software is what gives us the biggest clues, right? So you can see blue delta above the zone. So you see these wicks over here, these small tiny little wicks. You can see the price action peaking its head above the level and then aggressively selling off. You want to know what the context is behind sort of that key level, right? You're interested in context. You're not interested in candles. You're interested in context. So we see blue delta. So for those who don't know what the delta represents, for every price inside of the candles, we see these blue boxes and these red sort of boxes, horizontal boxes. Now, if we focus on some of the delta just above or just outside the zone, what we can see is a lot of blue delta. Yes, we see red delta, but we see a lot of blue delta peeking its head outside of the zone, right? Now, a very simple way to think about this is we see blue delta, which means there's more market buy orders and sell orders. Buyers are aggressive, but we broke below the zone. We didn't really break above the zone. We only wicked above the zone. And this is the science behind a wick. Blue delta means more aggressive buyers and aggressive sellers. They produce the wicks because passive sellers are present. So if we take this now to the gold footprint chart, the gold candlestick chart over here, what this tells us is at 43.50, right? 43.50, 43.55, there are more passive sellers resting in this region, right? These aggressive buyers were unsuccessful. So there are passive sellers sitting in this region, right? And that's what you want to focus on. So obviously that's now Bitcoin. So just going back to gold now, the way that I would approach gold going into the sort of week ahead is I've got my dealing range. So, we're dealing between this swing low and this swing high. This is the key level that is currently holding, and it's this simple. right, I want to be trading off this key level. So either we break below, so we see the absorption of aggressive buyers like we did up here, and we break below. Boom. Now, if we break below, we have decent amounts of liquidity resting over here. So for those who don't know what liquidity is, basically previous day highs, previous day lows. So we have Friday low, which is the Asian low, and we have Thursday low. So they create equal lows, right? That's one reason for lower prices. We also have this over here. We have, you know, session lows, trendline lows, stuff like that. And so how you want to be looking at this gold 15-minute chart, in my opinion, is if we can sustain lower prices below 43.40, then we're probably going down to about 43.09, probably 4300. However, if we can have a strong break above 53.55, then we use this same key level to take a break and retest to the upside. So the entire time, all you're looking to see is one key level, order flow inside the key level, a break above for a buy, and a break below for a sell. Okay, so the same thing applies to Bitcoin. So Bitcoin is cleaner than most people think, and you can definitely use order flow to enhance your swing trading or day trading on crypto, right? Specifically Bitcoin, because I've had quite a few questions about, can you integrate order flow into Bitcoin? You absolutely can. So we start with the 4 pillars the same way we did on gold, right? So market structure, dealing range, premium and discount, and fair value gaps. So what we can see here is we can see gold going through Bitcoin going through a bullish switching trend. So bullish to bearish. So we can see swing low, swing high, lower low, lower high, lower low. And so now our dealing range is this swing high down to this swing low. This is the 4-hour time frame on Bitcoin. So if your 4-hour time frame doesn't look like this, maybe you want to change it to this. Premium and discount. So right now we're in a discount, and so it's very simple. If we can stay above this swing low, then we're going to be targeting these sort of equal highs here near the equilibrium. So let's break this down. So from a 15-minute chart perspective, this is how I have my sort of zones over here, right? So again, if we go to the footprint, if we go to the candlestick charts on Bitcoin, so on Bitcoin, from a 4-hour perspective, again, what's interesting now is this. Here's our most recent swing low, right? So we're in a discount, right? And here we're in a premium. So price left a fair value gap over here. So I'm just going to zoom in quickly. I choose the candle before the fair value gap. So this here, strictly speaking, would be the key level, right? So the fair value gap is just below. The key level is the candle before the fair value gap, right? That is how I form my key levels, but we're far away from this price right now. This is about 102 to about 103. So right now we're in a discount, and we want to be targeting a premium. Now there's a few conditions to that, right? So I've not marked them up on the PowerPoint. So what we had, I look for fair value gaps, 4-hour fair value gaps in the discount, and I want to see how the order flow reacts at those zones, right? This is super important. So let's take this right now. So we take the candle before the fair value gap, just like this. We take the candle before and we just drag it across. So we want to see how the market was reacting to this area, right? We want to be looking at, so this is sort of 85,500 to about 84,000. So let's just say 84,000 to 85,500. So let's quickly, okay, so I've not got my order flow platform up on this screen, which is fine. Let's go to the 15-minute sort of chart right now. So going to a 15-minute, what we're looking for is we're looking for a similar sort of thing. So we're looking for market structure, dealing range, premium and discount, and then fair value gaps. So from a structural perspective, what we can see is a swing low, swing high, swing low, swing high, and then swing low, right? So this is your 15-minute dealing range, right? So 15-minute swing high, 15-minute swing low, just like this, swing high to swing low. Now, what we're looking for is this, right? We want to see how price is going to react. Are we going to go to discount first and then premium? Are we going to go to premium, then discount? So on the 15-minute chart, I don't see a huge, I don't really like the look of this price action. I don't like trading at the equilibrium. So for me, my best sort of prediction for Bitcoin will be this, right? I've got my eyes on this premium zone, right? So this huge fair value gap, price hasn't yet filled the entire zone. So if you're a Bitcoin trader, you want to be focusing on sort of 89 89,000 to 90,000. And so how you want to be doing this is we want to see price come into this area. Do we break below or do we break above? Right? That is how I would be looking at Bitcoin. So just to give you context, I wouldn't be looking for breaks of structure and market structure shifts in any of this. What I would be looking for myself is this kind of price action. So if we zoom into this, this is what you want to be looking for. So if you trade any kind of order flow or anything, I'm just going to take some random order flow and just to show you what you'd be looking for here. So if we get that up, let's get this up. There you go. So here in this case, if we want to see a break below, this is what you're going to be looking for. So when you see a break below a key level, what you're looking for is absorption. Because remember the rules we had for a key level. You want to see a 15-minute fair value gap. You want to see market orders being absorbed by limit orders. Now in this region, what you can see here is aggressive buyers, right? More aggressive buyers, blue delta, more aggressive buyers. Now the question is, when we come into this zone, if we break below the zone with the aggressive buyers being present, that indicates that the market buy orders have been absorbed by the sell limit orders. And this is the only reason the market actually moves down in the first place. There needs to be an absorption of aggressive buyers to confirm that sellers are in control of that zone. And that is the reason the market moves down. Now, from a bullish perspective, if we want to take a buy trade, this is how we're going to do it, right? We want to see the same thing, but in reverse. So let's break this down now. So what we want to look for specifically is this, right? What we're seeing is this. When we have a lot of red delta, right? Internal red delta, more aggressive sellers than buyers. When we see more aggressive sellers than buyers, but we see a break above the zone, this indicates that the aggressive sellers have been absorbed, right? Especially when we break above the zone. If we see anything like this, where we see a lot of red delta, it means that the sellers are trapped. Now, when the sellers are trapped, they've been absorbed, they haven't been rewarded. All these different terms mean the same thing. When aggressive sellers are present, but the market breaks higher, this shows us that the key level is holding as demand, right? There are more passive buyers sitting in this region, which drive the markets up. So it doesn't matter what market you're looking at. It could be gold, it could be Bitcoin, it could be NG futures, even Forex. It doesn't really matter. Whatever you're doing, get your key levels, define them with order flow, and just sit there and wait patiently for the markets to trade at your zones.